Hi, welcome to this session on Ind AS with Accountsman. In this series of videos, we'll start with the introduction and we'll also go down to cover every Ind AS. So, in order to start off, whenever we start discussing about accounting standard, Indian accounting standard, IFRS or any other reporting standard, the entire standard starts with the basic word of accounting policy. So, we can definitely not go ahead without discussing that word accounting policy. So what exactly do you mean by this word accounting policy is very important. Now assume that there is a point here and there is a point here and I am right now here. I am here and you are here and I want to reach you. If I want to reach you, I have multiple ways. One road which goes like this is what I can take, which is in blue, and there's one more road which is in green which I can take. So both the roads will take me to reach you. When both the roads are working and both the roads will fulfill the same objective, I have an option to choose among them. If I choose to go by the blue color road, it is my policy. If I choose to go by the green color road, that is again my policy. Meaning, whenever there is more than one option to fulfill the same objective and both the ways being correct, whatever I choose to follow is my policy. Similarly, accounting policy means there are instances in accounts where the same objective can be fulfilled with more than one way. You get that? And both the ways being correct, whatever the organization selects to follow is its accounting policy. This is the meaning. Example, now if you want to value the inventory, there is more than one method to value the inventory. You can follow LIFO, you can follow LIFO, you can follow simple average method and quite a lot of other methods. All of them being correct, whatever the organization selects to follow is its accounting policy. So this, my friends, is the meaning. In the examination context, we should be knowing the definition as well. So what exactly is definition? The definition of accounting policy is, it is accounting principles and the method of applying these accounting principles in preparation of financial statements. Yeah, let us write this. So whenever we talk about this accounting policy, I would basically use these acronyms RCB, PP. RCB plays amazingly in their power play. Yeah, what exactly do you mean by RCB, PP? R is rules, C is conventions, B means basis, P is practices and the other P is principles. Yeah, RCBPP, that is rules, conventions, basis, practices and principles in preparation and presentation of financial statements. Yes, what exactly do you mean by accounting policies? Those are rules, conventions, bases, practices and principles in preparation as well as presentation of financial statements. So now in this context, the word financial statement is very important. We not gonna work or not gonna bother ourselves with understanding of the word financial statements now. You can keep in your mind that financial statements means balance sheet and P&L account right now, but we'll have a detailed discussion of what is financial statements, when should we be preparing it, what and all will it comprise and everything with respect to Ind AS in the little later part in the coming up videos, especially when we start with our Ind AS 1. Yeah, so right now financial statements, you get that. So this is the accounting policy definition, but this accounting policy comes with lot of cons. So cons refer to disadvantages. So what are the cons with respect to cons or disadvantages that comes with accounting policies? First one is there will be no uniformity. Yeah, there will be no uniformity whenever we follow accounting policies, meaning different people are allowed to follow different accounting policies. So firstly, there is no uniformity. Whenever there is no uniformity, there is no standardization. And when there is no uniformity, no standardization and different people follow different policies, there will be no comparison. Meaning, assume that I and a friend of mine, both of us want to come reach you and we have two different ways. And if I come by cycle and my friend comes by bike, meaning different policies that we have, if one of us reaches you early, can you say the one that reaches you early is the fastest? No. In order to reach you and then compare our performance, both of us should be taking the same way, both of us should be taking the same vehicle. You get that? If either of us take different ways, then there is no comparison. So there is no uniformity, there is no standardization, there is no comparison. Yeah, and it will also decrease the reliability. Now whenever there is more than one way, you might choose that way which will lead to give the result what you want. Now if one of the method gives higher profit and one of the method gives lesser profit, you will choose the method based on whether you want to show high profit or low profit, which is actually incorrect, which is like window dressing your accounts. So it will decrease the reliability of accounts. So what exactly is accounting policy is doing? It is decreasing reliability, now to say removing uniformity, standardization and comparison. If it is doing something correctly, that is increasing difficulty in what? In selection of accounting policy. Now whenever you go to a hotel for breakfast, the bearer there gives you an option saying that, okay sir, what do you want? Idli, vada, dosa, puri, chapati. When he gives so many options, it will become very difficult for you to pick. Whereas mom eases this thing. She will tell, like when you wake up, she will say there is upma, if you want you eat it, if not no. So upma or uppitu. So she basically simplifies this selection among the options. Similarly, accounting policy, what it does is it gives you so many options, you don't know which one to pick. Not because you want to cheat, you don't know which one is best suited for your organization that way. So these are the problems with accounting policies. And if you want, we can discuss the examples that is there with respect to accounting policies. So what are the examples of accounting policies? Valuation of inventory, yeah, and valuation of property, plant and equipment. Property, plant and equipment is, as of now we can call it fixed assets, whereas what is PPE we will discuss when we start Ind AS 116, sorry Ind AS 16. So then revenue recognition, when to recognize revenue, yeah, valuation of fixed assets is done, valuation of intangible assets. All these are examples of accounting policies which will be simplified by the standards. Yeah, let us now go to the next part and then start saying what is the solution to all the problems created by accounting policies. So as of now we know that accounting policies has lot of cons or disadvantages. So we need a solution to all these cons. So the one-stop solution to all these cons is accounting standards. Accounting standards. Now what is the objective of accounting standards? The objective of accounting standards is the cons of accounting policies. What are they? If you start asking me, I'll tell you. Objective is to bring in comparison, to bring in uniformity, to bring in standardization in diverse accounting policies widely followed, standardization, then it will increase the reliability. What will it do? It will basically increase the reliability on the financial statements, yeah, and ultimately simplify selection of accounting policy. Previously whatever I told as the cons is now the objectives of accounting standard. Every con is countermeasured by preparing accounting standards. Now what exactly do we mean by accounting standards? Accounting standards can also be called as reporting standards. You get that? So now let us start discussing what exactly do we mean when we refer to reporting standards or accounting standards for that matter. Accounting standards are basically written documents, and these written documents can be issued by not by you and me. There are three specific names. First one, it can be issued by government. Secondly, it can be issued by expert accounting body, and lastly any other regulatory body. So what are accounting standards? They are written documents issued by government, expert accounting body or other regulatory body. When any of these bodies are issuing accounting standards, they have to specifically take care of 4 points. So what are they? First one, recognition. Second one, measurement. Third one, presentation. and lastly disclosure. So what are accounting standards? Accounting standards are written documents issued by government, expert accounting body or other regulatory body covering the aspects of recognition, measurement, presentation, disclosure. Yeah. Now let us see little in detail. Whenever we refer to this word government, we basically mean Ministry for Corporate Affairs in our country. You get that? Ministry for Corporate Affairs basically regulates the company and all the corporate affairs in our country. So it is regulated by Companies Act. You get that? Previously we had Companies Act 1956, under which section 210 subsection A basically led to formation of NACAS. NACAS was the name of the body. NACAS stands for National Advisory Committee on Accounting Standards. However, we know that there are a lot of happenings, that is in the year 2013 Companies Act was revised. Replacing the Companies Act 1956, what we have right now is Companies Act 2013. Under Companies Act 2013, there is a new body formed by name NFRA, which means National Financial Reporting Authority. So previously there was NACAS under 1956 Act. Under 2013 Act we have something called as NFRA, which is National Financial Reporting Authority. Then the next one, whenever we refer to the word expert accounting body, there is only one expert in the country in the field of accounting, that is chartered accountant, and the expert accounting body in the country is ICAI, Institute of Chartered Accountants of India. Institute of Chartered Accountants of India, using its power, has formed a body by name ASB, which refers to Accounting Standard Board, which regulates the issue of accounting standards in our country. Yes, so let us go ahead and then start discussing NFRA and ASB in detail. So we have Accounting Standard Board of ICAI's Accounting Standard Board. This Accounting Standard Board, using all its power, issued something by name Accounting Standards. And NFRA, or previously NACAS, NACAS, which was there, also issued accounting standards. And the accounting standards basically which were issued by ICAI's ASB and accounting standards issued by NACAS are same. There is no difference. Same to same, no difference. Like the way Sarfraz Khan says. So Sarfraz Ahmad, yeah. So accounting standards issued by ICAI, accounting standards issued by NACAS are same, except for the changes with respect to the applicability. The applicability given by NACAS is different, applicability given by ICAI is different. ICAI talks about applicability of accounting standards for all the entities, whereas NACAS talks about applicability of accounting standards for companies exclusively. NACAS is under MCA. NACAS is under MCA, so MCA basically controls companies exclusively. And going a little ahead, what happened with respect to this NACAS is now removed, and right now we have something by name NFRA, National Financial Reporting Authority, which is basically right now pushing towards something called as Ind AS. So what is Ind AS? I'll bring you to the story. Give me a little more time. Okay. So before going to this, I told you the objectives of issuing accounting standards is basically to bring in, the objectives were to bring in uniformity, standardization and comparison, increasing the reliability and removing the difficulty in selection of accounting policies. When you follow accounting standards within our country, what will happen is there will be comparison, uniformity, standardization within the country. But beyond one country, there will be no comparison, there will be no standardization. Meaning, India has India's set of accounting standards. Similarly, USA has US GAAP. Australia follows different set of policies. So does UK. So, if you have one company in India and a similar class of business operations are happening in US, UK or Australia, you cannot compare the results of the Indian company with that of the Australian company. So what is it? Now within the country there is comparison, uniformity. Now globally there should be comparison and parity that is to be brought in. In order to bring this in, there was something called as IASB, that is International Accounting Standard Board. I'll repeat, it is IASB, which stands for International Accounting Standard Board. IASB, using all its powers, issued something called as International Accounting Standards. What did it issue? International Accounting Standards. Over a period of time, they started issuing something called as IFRS, meaning International Financial Reporting Standards. So, International Accounting Standards, as well as IFRS, both are staying together now. So meaning both are in force. And Indians started feeling the point, saying that yes, we have to become global now. Yeah, there is lot of organizations which are from outside of the India starting to working in India. If we ask them to follow different set of accounting practices of our own, then it will become difficult, and it will make it difficult for them to perform actions in India. So in order to bring in that ease of business doing index and global comparison happen, Indians started thinking that we should start implementing IFRS in the place of accounting standards. So we should shift towards IFRS. But later, many of the geniuses in our country started telling like IFRS implementation to India would be devastating, because lot of things which are there in IFRS might not be suitable for India and the Indian economy. So what did they do? So accounting standards can't be followed anymore for companies, because it will not become global comparison. It will not help in global comparison. IFRS is good measure, but following IFRS is difficult, and it is actually not well suited for Indian economy. So they thought, let us meet in the middle. Let us meet in the middle, meaning let us bring something which is little more towards IFRS, but little also covers little similar to our accounting standards, that is Ind AS. So what exactly do we mean when we refer to the word Ind AS? Ind AS is Desi version of IFRS, meaning we were wanting to follow global accounting practices but not completely. So what did we do? We basically first took IFRS, and to this we did little bit of add and subtraction. We added something of our own, and we subtracted something that we didn't like. So these addition and subtraction what we did were called as carves. So whatever we added were called as carve in, whatever we subtracted was called as carve out. So if you take IFRS, add all the carve ins, subtract all the carve outs, that will give us Ind AS. So how is Ind AS and IFRS different? So I'll tell you what is carve in and carve out. Carve in means, carve in refers to those things which are actually there in Ind AS, but these items are not there in IFRS. So this is not something that's followed globally, but it is followed exclusively in our country. So next thing that we need to discuss is, what exactly do we mean by carve out? So carve out refers to those things which are there in IFRS but now removed, meaning it will not be part of our Ind AS. So those things which are actually there in Ind AS but not there in IFRS are carve-ins, that is new introduction by India. Whatever are those things which are actually part of IFRS but not part of our Ind AS are carve-outs. So IFRS plus and minus carve-in carve-out will give us Ind AS. The struggle to implement IFRS in India started in 2011, whereas in 2014, when NDA 1 government under the Prime Ministership of Narendra Modi came into picture, the urge was taken to the next level, seeing it as a revolutionary measure in the Indian economy, and it was put into force. So this is the introduction video in our Ind AS with Accountsman series. In the next video, we'll discuss the applicability of Ind AS and take it further. Yeah, thanks for watching.